Hello again, it's Ed McClements here, and we're going to talk in video number 9 about individual retirement accounts. As a disclaimer, we're going to be talking about a lot of tax law here, so I want to make sure it's clear. I'm not an attorney and I'm not a CPA. Nothing in this presentation should be considered tax or legal advice, and all viewers should be willing to seek their own professionals to help them with their own specific circumstances. Make sure you make the right call on your investments. As I said, we're going to talk about IRAs. Since the IRA is at the very heart of the payroll deduction IRA with automatic enrollment strategy that we talk about in our easy savings for use concept, it's important that all employers have a good solid handle on how IRAs work. The IRA was first created when ERISA was created. It was part of the 1974 legislation. But over the years, the IRS and Congress and the presidencies have gotten involved and made a number of changes to IRAs since those very early years. The IRS does have a publication called 590. It's about 61 pages worth of information about all the ins and outs of IRAs. But back in 1974, when IRAs were first created, the amount that a person could contribute was up to $1,500. Over the years, things have changed significantly. First thing to understand is the IRA itself is not an investment. It's actually a legal tax-approved strategy for being able to hold your investments and get favorable tax treatment on those investments to hopefully gain more value for you when you get up to retirement age. It's an interesting picture of President Reagan signing the 1981 Economic Recovery Tax Act at his ranch in Santa Barbara. In this law, the $1,500 was increased up to $2,000, and they also created a $250 option for non-working spouses. It was also expanded so that IRAs were now eligible not just to people who didn't have a retirement plan at work, but to everybody, even if you did have a retirement plan at work. Then in 1986, the Tax Reform Act was signed by Reagan. In this piece of legislation, deductions were phased out for those with high incomes if you did have or your spouse had a retirement plan available at work. In the Clinton administration in 1996, the Small Business Jobs Protection Act changed IRAs even more. Contributions for non-working spouses now could go up to the full $2,000 limit. 1 year later, in 1997, the Taxpayer Relief Act was signed by President Clinton, and this introduced the Roth IRA for the first time. That picture in the corner there is William Roth, a senator who came up with the idea of the Roth IRA. We'll talk more about that in just a few minutes. This law also liberalized some of the other deduction limitations for IRAs for those high-income earners. Then in 2001, the Economic Growth and Tax Relief Reconciliation Act was signed by President Bush. This phased a multi-year increase in the IRAs, now up to $5,000, and then in 2009 forward, those will occasionally be adjusted by the IRS to keep pace with inflation. This piece of legislation also added a $1,000 catch-up provision for those who are 50 years old or older. Then most recently, in 2019, the Secure Act was signed by President Trump. This legislation eliminated the maximum age that somebody could contribute to an IRA, at least under the traditional IRA rules. There is no maximum age under a Roth IRA. This also kicked up the age limit at which required minimum distributions need to occur. Under the prior legislation, once you turned 70 and a half, you had to start taking money out of your traditional IRA. And that's now been moved up to 72. This law, though, did also curtail something called a stretch IRA, which we'll talk about more a little bit later in our video. So to understand the technical side of these IRAs, it's important to understand how money gets defined in certain ways. A contribution is the amount you put into your IRA. The cost basis is going to be the term for the money once it's inside the IRA. Basically, your contributions become cost basis. The investment earnings is really the appreciation, the growth that you have on your investments once it's in the IRA. And the term for assets is the combined value of your IRA. It's going to be both the cost basis, your contributions, and the investment earnings altogether. The reason we make these distinctions is because the taxation of traditional IRAs and Roth IRAs hinge on how the money is defined. So let's take a closer look at the differences between the traditional IRA and the Roth IRA. To make it as simple as possible, the thing you need to understand about a traditional IRA is that you get the tax break up front and you get to save without having to pay any taxes. But you will pay ordinary income tax eventually on all of the accumulated savings and the growth of your traditional IRA. Under the Roth IRA, that gets flipped upside down. You actually pay taxes right up front before you put any money into the Roth IRA. But then the money that's in the Roth gets to grow tax-free, and all of the money, both the accumulated contributions and your growth, is eligible to be taken out in your retirement years without having to pay any income tax. So it's a question really of whether or not you want to pay the government now or pay the government later. It also really comes down to when do you think your tax bite is going to be the highest. If you've got high income right now and are paying high taxes, it might be smarter to go ahead and take that deduction up front. If you're relatively young and relatively low income, but you want to save for retirement, then it makes a lot more sense to be looking at the Roth. With this chart, we can take a closer look at what's important to you as an individual and whether or not that will drive you in a particular direction to the traditional IRA or the Roth IRA. If getting a current tax year deduction is the most important thing, then the traditional IRA is your better option. If avoiding all taxes on current contributions and growth over the years is important to you, then again, the traditional IRA might make the most sense. If allowing access to the amount you've put into your IRA during the next few years is something that you want to be able to do without having to risk any tax penalties, then the Roth IRA offers that feature. That's because you've already paid your income tax on your Roth contributions. So therefore, receiving tax-free distributions during retirement, if that's something that is a priority for you, then the Roth IRA does offer that advantage. If you want to avoid any required minimum distributions in your retirement years, again, the Roth is the way to go. If contributing to an IRA in addition to your retirement plan currently at work, regardless of income, is a priority, then the traditional IRA would give you the better pathway. If over your working life you've accumulated a number of other retirement plans from other places at work, then those pre-tax retirement programs, 401ks, etc., can be consolidated into a traditional IRA rollover without having to pay any taxes. If you already have Roth accounts, then the only way to consolidate Roth accounts is by putting them in a rollover into an existing Roth account without having to pay any taxes. Let's talk about the IRA contribution limits. As you can see from this chart, both the traditional IRA and the Roth IRA have identical annual contribution maximums. It's $6,000 if you're under age 50, and if you're 50 or older, you get $7,000 as the annual contribution maximum. It is clear that the simple IRA and the SEP IRA and the 401k, 403b, and the 457 plans do have much higher annual contribution maximums. But keep in mind, these are programs that are sponsored by employers, and they are not eligible for individuals to just create on their own. It's also important to keep in mind that you could actually contribute to both a traditional IRA and a Roth IRA in the same tax year. You would not be able to get a higher contribution maximum though. So if you're only 28 years old, you would still have a $6,000 maximum. You might split that evenly 50-50, $3,000 in each, a traditional IRA and Roth IRA, but such a decision would be completely up to you. It's also important to keep in mind that the IRS requires that you must have earned income equal to or higher than the amount you're going to contribute into your IRA. The IRS defines these, what it considers earned income. A simple quick chart is things like salaries, wages, commissions, self-employment income are all considered earned income. Things such as dividend and interest income on investments is not. Deferred compensation, income from some types of partnerships are not considered earned income. For a deeper analysis of whether or not your income is sufficient to qualify for contributions to an IRA, we suggest taking a look at that IRS publication 590 or consulting a tax professional. Let's dive into the contribution limits in a little bit more detail. The first thing that I need to point out is that there is a difference between contribution limits and deduction limits. You may actually be able to make a contribution to a traditional IRA that you actually cannot deduct in the current tax year. The question might be, well, why would I want to do that? Well, it's because you want to put additional monies away and have that tax deferred growth, even if you can't take a current year tax deduction. But let's take a closer look at what determines your deductibility. As you'll see from this chart, there are two color sections, a green section and a yellow section. So the difference between the two is whether or not you are covered at work under a retirement plan. If you do have a retirement plan at work, you're going to be looking at the green chart. If you do not have a retirement plan at work, you'll be looking at the yellow highlight chart. Next issue is to determine your tax filing status. Are you somebody who is single? Or are you somebody who's married filing jointly? Are you somebody who is married filing separately? That will also determine whether or not certain amounts of your contributions are deductible. But it gets a little bit more complicated than that, because you can see within each of those categories there are income thresholds that determine ultimately what is deductible and what isn't deductible. There's also this term of modified adjusted gross income. Let's put aside the definition for that for just a moment. We'll get into that in a moment in a little bit more detail. But as you can see, depending on your filing status and your income threshold, that will determine whether or not you have a deductible amount for your contribution to a traditional IRA. Let's take an example. Somebody who is married filing jointly, who does have a retirement plan at work, they have to make less than $104,000 to be able to take a full tax deduction on their traditional IRA contribution. If they make more than $104,000 but less than $124,000, then they may get a partial deduction. If they make more than $124,000, then they're not going to be eligible to take a deductible IRA contribution. They may, again, still make a contribution to their IRA up to the contribution limit, but they will not be able to take a current year tax deduction for it. Let's take a look at the contribution limits with the Roth IRA. With the Roth, it's a little bit simpler, but there are still thresholds to be concerned with. There's a similar design regarding your filing status over here. You'll also have to take into consideration your modified adjusted gross income, and that will determine whether or not you have a contribution limit or not. As you can see, from single individuals who make more than $139,000, they are not eligible for a Roth contribution. So with this type of program, a Roth IRA, you can get maxed out based on income, unlike the traditional 401k where you're never maxed out on the contribution amount, but you can be eliminated from being able to deduct that amount in the current tax year. Because of this differential between the rules for a Roth IRA and traditional IRA, there's a concept called a backdoor Roth IRA. Let's say you make $150,000 and therefore are ineligible to directly contribute to a Roth. You could put the money into a traditional IRA account. then you could convert that IRA account into a Roth IRA account. You can get the forms for this process from your IRA custodian. But be prepared to pay some taxes. There are going to be taxes due on the conversion from the traditional IRA into the Roth IRA, because remember, only after-tax money can be put into a Roth IRA. There's also what's called the IRS pro rata rule. In other words, if you have existing traditional IRA accounts already, before you try using this backdoor Roth IRA technique, you may still have some additional taxes to consider before you pull the trigger on this. So again, be prepared to take a look at additional taxes for this technique, but it is a way that people with high incomes who want to use the Roth IRA as their investment vehicle can actually get to the Roth IRA by first going through the front door of a traditional IRA and converting that traditional IRA into a Roth IRA. This might seem a little sophisticated, and it kind of is, so we certainly recommend you getting professional tax advice before trying any of this on your own. Let's take a look at that concept of modified adjusted gross income. Here we see again publication 590 from the IRS, 61 pages of great information about how IRAs work. In this, you'll find a more detailed explanation of how the MAGI, the MAGI, actually is calculated. Basically, it's your adjusted gross income from your 1040 form, and then you add back into that amount some things such as traditional IRA deductions for the year, or any student loan interest deductions, tuition and fees deductions, and foreign earned income and foreign housing deductions, any excludable qualified savings bond interest, and any excludable employer provided adoption benefits. Many people will find they have no incomes that need to be added back in, and their modified adjusted gross income is basically a bunch of zeros being added on to their adjusted gross income. In other words, their modified adjusted gross income is identical to their adjusted gross income. There are other IRAs that we need to talk about. It can be a little confusing the way they name things in the marketplace. There are simple IRAs, there are SEP IRAs, there are self-directed IRAs, there are inherited IRAs, and there are things called stretch IRAs. Let's take a look at the simple IRA. It stands for a savings incentive match plan for employees. This is a special type of kind of simplified retirement plan available to employers who have less than 100 employees. In a simple IRA, it allows the employer and employee, kind of like in a 401k, to make contributions to the program. But the savings aren't deposited into a 401k account. It's deposited into individual IRA accounts that are set up for each participating employee. A typical design for a program like this is where the employer matches the employee contribution on a dollar-for-dollar basis up to the first 3% of salary. Under these types of programs, the employer contributions become 100% immediately vested for the employee to take with them if they quit the company after the contributions made. Let's contrast the simple IRA with the next on the line, which is the SEP IRA. SEP actually stands for Simplified Employee Pension. So a SEP IRA is another employer-sponsored retirement plan. Under the SEP IRA, annual contribution limits are significantly higher than those under traditional IRAs. You can actually put up to 25% of salary in a SEP IRA. But only employers, not employees, are eligible to make contributions to a SEP IRA. And the decision as to whether or not to fund the IRA each year is up to the employer, and what percentage goes into the SEP IRA is also something the employer can decide on each year. It must be the same, though, for all employees in the SEP IRA. These types of simplified employee pension plans are eligible for any size employer. Employees can manage their investment decisions once the money's in their SEP IRA account, subject to the plan sponsor's investment decisions and any framework provided by the investment trustee. Like the simple IRA program, employer contributions to SEP IRAs are 100% vested, so you need to keep that in mind. If employees leave the company, they get to take their SEP IRA contributions with them. The next in line is the self-directed IRA. A self-directed IRA is a little bit of a misnomer because in some sense, all IRAs, whether they be traditional or Roth IRAs, do come with some level of individual direction as to where the money is invested. But self-directed IRAs take this up to a much more significant level. With a self-directed IRA, whether it's a traditional design or a Roth design, the taxpayer can hold much more than a normal IRA would allow them to invest in. In other words, banks, CDs, stocks, bonds, mutual funds, and ETFs are things that most typical IRAs allow, and to some degree, every IRA has some level of self-direction to be able to choose investments within those categories. But with a self-directed IRA, you're actually working with a more sophisticated design where you can actually hold investments such as precious metals, commodities, private placements, limited partnerships, tax lien certificates, real estate, and other types of alternative investments are eligible in a self-directed IRA. In general, self-directed IRAs are only available through specialized custodial services. Because they're specialized, the fees for a self-directed IRA can be significantly higher than a traditional IRA design. Self-directed IRA custodians can't give financial or investment advice, so this is really only for a more astute, educated, and somewhat seasoned investor who understands the pluses and the minuses and can do the due diligence of investing with knowledge about how those investments may perform. It's also important for the holder of a self-directed IRA to be aware that prohibited transactions, if found out by the IRS, could invalidate the tax status of that IRA and subject the entire funding to a significant tax bill. Turning our attention now to inherited IRAs. Just as the name implies, somebody who had an IRA has passed away and is leaving that to their beneficiaries. If a beneficiary has not been named already through the paperwork that the original account holder of the IRA used when they set up their IRA, then the spouse is first in line. If the spouse is no longer living, then any surviving children are next in line. And if there are no surviving children, then the estate of the IRA holder is eligible to distribute any assets. In the case of a spouse being the primary beneficiary, the spouse actually has some alternatives to consider. They have the option of converting their deceased spouse's IRA into their own IRA. In other words, making it as if they had made the contributions all along. This gives them the power to elect an alternative beneficiary once they die. It also gives them the option to continue to make contributions to that IRA that they took over from their deceased spouse. They can also decide to renounce the IRA. That situation would avoid the spouse being taxed at all, and the assets of the IRA would pass on to the next people in line, most likely children of the original account holders. In the event that there is no spouse involved and the IRA is being left to non-spouses, inherited IRA has some requirements in terms of required minimum distributions, RMDs. Basically, the account needs to be liquidated over a period not more than 10 years. The stretch IRA actually directly relates to that prior concept. The stretch IRA was an estate planning strategy that extended the tax deferral benefits of an inherited IRA to the non-spouse beneficiary. Under the old rules, prior to the enactment of the Secure Act at the end of 2019, the beneficiary of an inherited IRA could turn that IRA into a distribution that was based on the beneficiary's life expectancy. In other words, if you had somebody who is in their 80s and they passed away and they gave it to their child who is only 61, then the distributions could be based on the 61-year-old's life expectancy, not on the 80-year-old's life expectancy. This tactic, which was helpful in avoiding some of the taxes and spreading out the payments over a longer period and keeping tax deferral working within the fund for a longer period, was ended, as I said, through the Secure Act of 2019. Therefore, now non-spouse inheritors of an IRA have only that 10-year period in which to take the distributions from the account. Because this went into effect at the end of 2019, people who did start a stretch IRA, in other words, inherited a IRA under the old rules, are eligible to keep that stretch IRA status. Let's talk a little bit about IRA custodians. These are the banks, whether they be brick and mortar or online, or the investment houses, or the credit unions, or the robo-investment services that are available on the web now, or the life insurance companies. All of these financial institutions offer some form of IRA programs for their clients. The important thing to keep in mind is these programs all differ. They do have different offerings, they have different fees, and they have different investment solutions available to their clients. So it's important to take a look at which of the options out there is a good fit for how you want to interact with your IRA over time. Typical investments into an IRA are something as simple as a CD, a certificate of deposit at a local bank. Those aren't paying very high interest right now, so most people do want something much more aggressive. There are money market accounts, there are stocks and bonds, and collections of stocks and bonds, also known as mutual funds, and then things called electronically traded funds, which is kind of like a mutual fund that has eliminated a lot of the active investor management and therefore reduced the internal expense load. So they're a version of mutual funds that have a little bit simpler approach to how investments are being made. There's also the opportunity to contact an insurance company, a life insurance company, and ask for an annuity. Annuities are contracts that have more guaranteed investment returns, but they also have some downsides. But these are the types of insurance contracts that are potential investments for a person with an IRA account. There are a lot of things that IRA accounts cannot invest in. They cannot invest in life insurance contracts, but as I said a moment ago, annuities are okay. The IRA cannot invest, though, in collectibles. What constitutes a collectible is a little open. There are things such as artwork, rugs, antiques, gems, stamp collections, coin collections, wine collections. All of those types of things are not suitable investments for IRAs. The IRS does not want you investing in these kinds of categories for your IRA money. But there are some exclusions. When we mentioned coins earlier, for example, bullion is actually eligible for IRA investment. In particular, silver and gold bullion from the US Mint is a potential investment for your IRA money. Let's talk a little bit about hardship withdrawals. What happens if you need the money and you haven't reached retirement age? In general, under traditional IRAs, you need to be 59 and a half, or you're going to subject yourself to a potential 10% penalty on withdrawing money from your IRA account. But again, these hardship withdrawals are certain provisions that allow you to take a certain amount of money out of your account without being subject to that 10% penalty. Keep in mind that people who have a Roth IRA would allow them to take the money back out of the Roth IRA at any time without any penalty. The down payment for a home is eligible up to a $10,000 maximum. Qualified higher education expenses for yourself, for your children, or your grandchildren are eligible under this hardship provision. Unreimbursed medical expenses that exceed 7.5% of your adjusted gross income a year. Health insurance premiums if you're unemployed. Withdrawals that are due to a total and permanent disability. And a feature called substantially equal periodic payments is a way that somebody can take deductions from an IRA over a 5-year period, or if longer, up to age 59 and a half, whichever comes later. The bottom line for that one is that there's 3 particular kinds of methodologies for calculating the amounts, and the IRS will allow you to, in essence, deduct money out of your IRA on a consistent basis, even if you're less than 59 and a half, and still not subject you to the 10% penalty. With each of these, though, you are still subject to normal income tax for the deductions from your traditional IRA. There's additional category of withdrawal for a IRS levy, or if you made a withdrawal once you've been called up based on your status as a military reservist. The economic hardship has to be in line with that withdrawal amount. In other words, you can't take out $30,000 for higher education if the college education only costs $22,000. You may be asked for proof as to how much the withdrawal was made for and aligning that with one of these categories. Most recently, the coronavirus has impacted legislation which broadens the hardship withdrawal. Due to the coronavirus, taxpayers who are impacted can now take up to $100,000 out of their 401ks or IRAs. The withdrawal is not penalized and there's no mandatory withholding. You can have longer to pay the resulting taxes also. You will be paying ordinary income tax on this money, but that can be spread evenly over the next 3 tax years, 2020, 2021, and 2022. If you can find a way of paying back the amount you withdrew within those next 3 years, you can even get a refund on the taxes you paid. These distributions are allowed if you or spouse or dependent has been diagnosed with COVID-19, has experienced adverse financial consequences from the coronavirus, such as your hours being reduced or being quarantined or being laid off or furloughed. If you've not had access to childcare and that's prevented you from being able to work. If you've owned a business that's had reduced hours or is closed entirely, or other factors that have been deemed appropriate by the Secretary of the Treasury. Let's talk for a minute about this required minimum distribution concept. Basically, Uncle Sam wants to get some tax money eventually from these IRA accounts. Keep in mind that Roth IRAs do not have required minimum distributions. So if you're in a traditional IRA, there are going to be required minimum distributions that you'll eventually have to deal with. Basically, once you turn age 72, the government is going to want you to start pulling some money out of your retirement account so that they can start taxing you on it. The IRS gives you a little bit of leeway in the very first year. You get up to April 1st after the year in which you turn 72 to make your first required minimum distribution. But if you use this technique, be aware that you'll still need to make a second deduction in the same year for that tax year. Retirees can always take out more than the required distribution amount. And if you have multiple accounts, you're going to have to calculate your required minimum distribution from each and make sure that you hit the required minimum distributions on all accounts. In terms of how these are calculated, the IRS actually has 2 different tables. One that they use when you have an IRA and a spouse that has more than a 10-year younger age than you do, then you may be looking at the joint and last survivor table to help calculate the required minimum distributions. If you have a spouse that's less than 10 years younger than you, or if you don't have any spouse at all, you're going to be looking at the uniform life tables to help calculate how much of your IRA balance you need to distribute in the current tax year in order to avoid penalties. It's important not to skip one of these required minimum distributions because the tax penalty on them is severe. You get a 50% tax on the amount you didn't distribute in any tax year where you were supposed to take a minimum required distribution but didn't. Now, the CARES Act has suspended the required minimum distribution rules from retirement accounts for this current tax year of 2020. Let's talk a little bit about bankruptcy and creditor protection of these IRA accounts. Under federal law, both traditional and Roth IRAs are protected to a total dollar amount that has now, because of inflation, increased to $1,362,800. This limited protection is the sum of all traditional and Roth IRA accounts. It's the amount per individual, not per account. But it's not quite that simple. For example, in California, does have protections for creditors that allows them to access your IRA if you haven't declared bankruptcy. There's no single rule that the court applies in these situations. Basically, the courts are going to decide on how to divide your retirement account between you and the judgment creditor, the person who has sued you and won a judgment against you. A typical California court will ask two questions. Do you need these retirement funds right now? And how likely will it be, based on the circumstances of your individual situation, that you'll be able to replace this retirement income? If you're relatively young and you're relatively well paid, the courts may very well see that it's most appropriate to give your IRA funds to your judgment creditor rather than allow them to save up for your retirement. Some key points to remember as we wrap up this discussion of IRAs. IRAs, because it involves tax law, can be somewhat complicated. And they are, the government that is, are always tinkering with the rules, whether it's the IRS or Congress or the presidency. They're always looking for ways of increasing or sometimes decreasing the benefits of an IRA. So it makes sense to take some time to get yourself educated on how IRAs work and encourage your employees who may be using IRAs through our Easy Savings for You concept to become educated themselves. You can search the IRS website for any publications and for more info. And there's two websites in particular that seem to give pretty good non-biased information. Investopedia.com and nerdwallet.com have been helpful in putting together this presentation. So we can recommend them as someplace for you to turn to get additional information. As an important closing tip, it's always good to have a good CPA, someone who really understands these rules and can take a look at your specific tax situation and your life goals to determine how to best use these rules regarding IRAs to your best advantage. Thank you very much.